Well, thank you very much, Sue, and thank you all for coming this morning. It's always a great pleasure to be here, and particularly on this trip, because as you all know, the weather in New York at this time is not particularly great, and I just had the good news that it's snowing again. And then, of course, it's close to 90 degrees here coming this weekend, and I'm sure we're all enjoying it. It's great to be at Macquarie again, in a sense, although this is not their campus, and back in Australia. I've been here, I'm not sure, it's hard to remember the number of times, but I think I've spent about 2 months of my life crossing the Pacific on an airplane, getting to and from Australia, maybe about 30 times. The first time was 1981, and that was really an eye-opener, and it's really so good to be here with so many good friends, and to be invited for the third time for an event by Macquarie University, and to work with some of their outstanding faculty, and to be part of this conference today. And also I'd like to thank several of my friends here, because we're staying at McMahon's Point, and going to Milson's Point up here for a conference is not very attractive to the cab drivers here. And so I've had this experience of having to call friends at the last minute to pick me up because the cabs decided that they didn't want to take a guy from the West Village in Manhattan up to Milson's Point. And I don't always get to conferences anyway on time. I had this interesting experience. I was giving a speech in the south of France, and my wife was with me, Elaine, and she said, is there time to go to the fish market? And I said, well, I'm giving a talk at 10:30 this morning, but yes, but we have to get back in time for the speech. So in fact, we went to the fish market, and while we were there, my cell phone went off, and on the other side of the cell phone was my driver. Whenever I'm in the south of France, and particularly the north of Italy, I do some work for an organization called the Centrale di Bilanci, and they are like a giant balance sheet computerized clearinghouse for financial data on companies in Italy, where they take the data and massage it and feed it back to the banks to make hopefully good decisions. And my driver for the last 20 years has been a fellow by the name of Mario. And Mario was on the other side of the cell phone. He says, Professor, where are you? And I said, well, I'm at the fish market. He said, no, Professor, you should be at the hotel. There are 1,000 people waiting to hear you speak. And I said, no, Mario, it's impossible. I'm speaking in 2 hours, not at this point. He said, Professor, I am there, and they are waiting for you. He said, may I ask you a question? I said, what's that? He said, what are you speaking about today? So I said, well, I'm speaking about managing credit risk. He said, oh, Professor, I've heard you give that speech so many times. Today, perhaps I can give it for you. And I said, no, Mario, you have to understand, this is a highly sophisticated audience, bankers, regulators, scientists. It's impossible. He said, do they know what you look like? And I said, no, I don't think so. It's the first time I'm giving a speech at this conference. He said, well, you are there, I'm here. What opportunities do we have? I said, okay, Mario, if you think you can pull this off, you be the professor today, and we'll exchange roles, but I won't get there until late in your speech at the earliest, and it's all up to you, but really, I don't know if you should really do this. He said, Professor, trust me. So sure enough, I get to the conference, and he's doing a fantastic job. He's got all the equations down pat. The timing is just right. He's getting, you can see that the audience is really engaged. And I'm standing in the back now, and I'm feeling really good, and playing the role of the chauffeur, and he's the professor. And he finishes his speech, and he gets this really enormous round of applause. And I'm feeling much better, and you see he's really smiling and the like. And then he finishes, and the moderator says, Professor Altman, is there time for 1 or 2 questions? So now I see Mario beginning to sweat a little bit and looking a little concerned, and I'm feeling very uneasy in the back. And he said, well, maybe one or two. And sure enough, this distinguished scientist in the back stands up and asks this incredibly complicated mathematical question. And now I see Mario really beginning to sweat, and I'm feeling, terrible back there. And but this Mario, he didn't really know the answer, but he's a very clever fellow. And he said, sir, that question is really so simple. Even my chauffeur in the back of the room can answer it. Well, perhaps you've heard that story before. But let me tell you that 2/3 of that story is true. And perhaps you'll catch me at the tea break for us to find out which of the third is not. But seriously, I'm really indebted to many of my friends for driving us around and showing off Sydney, and it's been terrific. Also, from the comments that you heard before, about one of them about my colleague Rob Engel from NYU, and interesting story is that the year he won the Nobel Prize, I think it was 2003. That same year, I missed getting the Nobel myself by about this much, truly. The reason was his office is this far away from mine. And it's really great that he's doing work with the CIFR, which I didn't know until last night, and we hope that that tradition will continue. Now, to be a little bit more serious, we're going to be talking about a subject which is relatively new in terms of my research over the years, but it turns out to be very timely as we all read about and hear about the crisis that is going on in Europe over the last several years, and of course has been reinvigorated, so to speak, by the events in Cyprus, which have taken place just a few days ago. But the interesting thing about my relationship with sovereign risk is the fact that I have always been known as a corporate person, so to speak, in terms of emphasizing the private corporate sector as the focus of my research, whether it be in capital markets, risk management, or corporate finance. And in fact, we put together, I think, the first executive program on risk management ever constituted anywhere in the world in 1985, when a colleague of mine, Ingo Walter, and I were having a beer outside of a factory in Germany, and we literally on the back of an envelope wrote down the outline for what has become a fairly standard type of risk management executive program involving such things as credit risk, operations risk, market risk, some new topics like reputation risk, and systemic risk. And while there, one of the topics we put down was sovereign risk. And then we took the outline and actually sold it to a university in France, INSEAD, and gave executive programs on this subject for about 20 years. But over that 20 years, the topic of sovereign risk became less and less interesting to the people who are running the executive program at INSEAD. And in fact, finally one day we got a note saying, please take out sovereign risk as part of the program. It's not really that important. And so we did, although with a great deal of reluctance, mainly because my colleague was interested in it, and I was more interested in the corporate side. There was one event in my background that really interested me with respect to sovereign risk. It happened, and then I forgot about it until the current crisis in Europe. And that was, in fact, I'd like to ask you a question for you to reflect on the situation. I'll show you the outline of my talk today, among other things. We're going to talk about current conditions in credit markets and the recent crisis in Europe. And that's the area that I'm focusing on right now for obvious reasons. But if you went back to the last area in the world that had a regional financial crisis, one of those areas was Asia in 1997, 1998. Some of you may remember it, many of you are too young to remember it, but may have read about it. And you remember it all started in Thailand, and it spread to Indonesia, and then east to East Asia. And it was a really significant regional sovereign risk crisis, with many countries either defaulting or almost defaulting in that period. So let me ask you a question. If you went back to a year just before the crisis hit, which was 1997, so let's say year-end 1996, what country in all of Asia would you have selected as having the most vulnerable private sector, private corporate sector, financial risk, the risk of default of companies in that country? What country in all of Asia had the highest financial vulnerability to default risk of any country in Asia? What would you have selected? 1996, before the crisis. Any brave soul? By the way, no grades this morning on this. What would you select, Charles? Philippines. No, as a matter of fact, they were not. If I recall, they were not as even in the top 5 in terms of the worst countries, but they weren't great. Yes. Japan was number 4 from the bottom. Indonesia was 3. Any other guesses? Thailand, that's an obvious one, number 2. Who was numero uno? South Korea. And the interesting thing, and I'll back that up with some data in a moment, but the interesting thing about South Korea, as of December 1996, their bond rating was AA-. They were one of the Asian tigers with the biggest teeth, if you may recall, and they were flying high. 6 months later, their rating was BB-, and they would have defaulted on their outstanding international debt if it wasn't for a $50 billion bailout from the IMF in 1997-98. I forget the exact date. The interesting thing is, there was a raging debate at that time as to what was the cause of this sovereign crisis in Asia, and particularly starting in Southeast Asia and then moving to East Asia. And there were 2 schools of thought. One school of thought says it was the flight of Western capital, which caused a run on the currencies. It made companies and sovereigns that denominated their debt, international debt, in non-local currency like dollars, instantly vulnerable to default overnight. And indeed, some of these countries, the country's currency dropped by half to 2/3 within a very short period of time. And if you had to pay back in dollars, it became unsustainable. The other school of thought said, no, it's the basic infrastructure and leverage and risk of the financial and non-financial systems in those countries. Well, the World Bank did a study. I had nothing to do with the study, and one of the metrics they used to measure the health of the private sector of these countries was my original Z-score model, which some of you may have heard of. We built that model about 100 years ago. Thanks for laughing, but it was a long time ago. Actually, it was 46 years ago. I remember this number exactly because it's the year I was married, and also I got my first job, and only job. I mean, it's the only job I can get. So that's the NYU job that I've had all these years. And when we built that model, we had no idea it could be used for many things. Well, one thing they did, the World Bank, is they looked at the average Z-score of the private sector of these countries. And they came up with this hierarchy of risk. And number 1 was South Korea. Well, you may have heard of something called a chaebol. A chaebol are these large conglomerates that operate in Korea. I think it's called Zaibatsu in Japan. 7 of the top 30 went bankrupt within 1 year of this crisis starting. So it wasn't just the small and medium-sized companies that succumbed. It was, in fact, the largest, most powerful companies that went bankrupt within 1 year in South Korea. They restructured very well, a lot of austerity, and that model is still being used today in Europe. But it doesn't work nearly as well in a highly socialistic economy like Greece, Portugal, Italy, Spain, and of course we're finding out for a different reason in Cyprus. At any rate, that stylized fact remained in my mind, even though I never did any research on sovereign risk, until the crisis began to emerge in Europe. And some people put the date of the emergence of this crisis in Europe to the time that the Prime Minister of Greece announced that, in fact, the deficit to GDP of Greece was not 6%, but close to 13%. And of course, the politicians at that time blamed the politicians from the prior government for this fraudulent information that was highly controversial at the time. And I think that happened in late 2009. So it wasn't until late 2009 that we began to get worried about Greece. So I began to think about that time, could we have looked at the standard metrics that are used to assess sovereign risk back in 2008 or 2009 and say this country, that country is most vulnerable to default risk because of their various problems. Well, it turns out that the bankers, the regulators, the rating agencies, none of them were very concerned about Greece, even though they were certainly one of the worst run countries in Europe, using traditional indicators of risk, which you may be able to see here are macro-related variables. So what do you read about when you pick up the Financial Times or the Fin Review, I guess it's called here, or the New York Times or whatever, about a country's problems? You read about debt to GDP, right? So Greece is 165, 170%. Italy is 127%. I'm not sure what Portugal is. Cyprus probably is not nearly that high, except for their banking system's problems, which I'll get back to. Or you read about deficits to GDP. Some bright person, I have no idea who it is, if anybody out there can tell me, came up with a benchmark in Europe that says, no, thou shalt not have a deficit to GDP greater than 3%. This is a standard benchmark in Europe. Turns out that just about everybody has a deficit to GDP greater than 3%, including the strongest countries like Germany and France, etc. They continually flaunt that benchmark, and so nobody took it very seriously for a long period of time. Productivity, unemployment, trade deficits, these are all the metrics that the banks, the investment banks, the regulators, certainly in Europe, look at when they look at the vulnerability of a country's ability to service their debt going forward, and of course the interest rates that they pay on the debt. So I began to think about this and then look back at the research, and by the way, my paper on this subject is on the Macquarie website. Linda Drake here has been wonderful in hosting me for many administrative details here, sitting right here, can direct you to the website and that paper which I sent 2 weeks ago. It's a paper that has been published already, although we are continuing to do research in that area. Anyway, these historic indicators and models to predict sovereign risk, I must say, and maybe it's easy for a new researcher in this area to make this statement, but they've been basically ineffective. We do not have a good early warning system for sovereign risk that have worked over the years. Yes, we know after the fact that some country is in trouble. But usually, the news of a country's problems, like South Korea back then, like Italy, Spain now, comes long after everyone already has read about it in the Financial Times or has looked at the credit default swap prices, which I'll get to in a moment. Why have we not been that effective as academics and as practitioners to predict sovereign risk, where we have a fairly good record when it comes to predicting the risk of companies and their vulnerability to distress and defaults? And as you heard before, this is an area that I love to read about. As a matter of fact, my wife and I have this tradition of opening up a bottle of fine red wine every time there's a big bankruptcy. And if there are 2 or 3 in a short period of time, we move to the fine champagne. Well, in 2001, 2002, and certainly in 2009, we were drunk all the time. It was just a fantastic period for people doing research. But you have to understand, as an empirical researcher, we need data points, observations. One of the bad things about Australia, the really unfortunate things, is you folks haven't had a downturn since the 1990s. And so your banks have very little data on, and maybe Charles knows this better than anyone, or his group, on loss given default, because you have relatively few defaults over the years. Yes, you have defaults, and every so often I read about them, and of course when I was here teaching various times, I read about them firsthand. But the thing is that you need data to build good empirical models. If you don't have it, you either have to borrow it from countries that have it, or use some sort of simulation techniques or Monte Carlo simulations and others to come up with reasonable loss given default models, which is now required under Basel II and soon to be under Basel III. And so not having the data is or let's put the other way around, coming from the United States, we have the luxury of large numbers of defaults and bankruptcies over many cycles, and that helps in building these models. But they have not been very effective, that's the bottom line, with respect to sovereign risk. So that brings me to a discussion of where we are today. This chart may look familiar to you. It is a chart that shows the yield spread, either the yield to maturity spread between so-called high-yield junk bonds and what used to be called the risk-free benchmark U.S. government bonds. Now we don't call it risk-free anymore, we call it the benchmark, whether it be U.S., Germany, or whatever or Australia maybe even, as the benchmark for a very low-risk security. And the difference between that, or the spread, is kind of a risk premium. And it's a measurable one, either using yield to maturity, or the red line there is the option adjusted spread, which takes into consideration embedded options in the corporate debt securities. At any rate, back in 2007, left-hand side of the graph, the spread between risky debt and risk-free debt was 260 basis points, or 2.6%. That was the lowest spread in the history of mankind. We try to make it a little bit more dramatic, but basically it was the lowest spread certainly since the Great Depression. And that was in June 2007. And yet, if you looked at the credit quality of the companies that made up the composition of the index of high-yield bonds, you may have concluded, as I did, that never before had we seen a more risky corporate sector. So something was completely upside down from what we teach and what you practice in the real world. Investors were getting very low returns for extremely high risk. It made no sense at all. And yet, as the saying goes, the music kept playing and everyone kept dancing and the train kept going down the line, so that money was easy, investments in alternative investments were rampant. Regulators seemed to be looking the other way, at least in countries like the United States, particularly from what eventually materialized into the catalyst for the great financial crisis. Well, that's a great term. You know where I heard the term GFC first? Here in Australia. I never heard it before. I was visiting at the University of Western Australia for a month a few years ago, and I heard the GFC. Well, what's this GFC? They said, it's the global financial crisis. Haven't you heard about it? I said, of course, I guess you mean, but we never call it that. We call it the financial crisis. And then the irony is, you guys didn't go through the crisis, so it should be called the global financial crisis ex Australia. It means essentially, it's like looking at the rest of the world, but I mean, maybe your stock market suffered, but not much in terms of, did you actually have a recession here? I don't think so. So, very different. Anyway, back in 2007, lowest spread ever, very high risk. If you looked at the fundamentals, what you might say what's happening or happened in Europe, if you looked at the fundamentals of European countries, particularly the Southern European countries, in 2008, 2009, and up to the present, and I'll show you the present data, you would conclude, as we have, that many of these countries are fundamentally non-competitive with extremely high corporate risk, not to mention the sovereign risk, and perhaps we can use that as a metric for health of a sovereign. Let me just bring you up to the present. So if you go to the right-hand side, by the way, that spread went to over 2,000 basis points in December 2008, during the worst part of the great financial crisis, over 2,000 basis points. To give you an idea what 2,000 basis points as a spread means, the highest it ever was prior to this cycle was 1,100 in 1991. And in 2008, it was almost 2,100 basis points. No one was borrowing then, obviously, at those high rates. Nobody would lend. Banks weren't lending to banks. Central banks of the world were all scratching their heads as to what to do. Were we really in a great financial crisis? No question about it. Would we come out of it was the big question. And how soon? Well, I guess if you look at financial crisis from a historic standpoint, and I am not an economic historian, but obviously the world has survived many crises in the past, and you might say, of course, we're going to survive. But we need to do something about this quickly. And the US Fed and some of the other central banks of the world began pumping enormous amounts of liquidity into the system, which, by the way, is continuing up to this very day. In the United States, we are still pumping $85 billion a month into the purchase of either government securities or toxic assets off the bank's balance sheets. And the question is, and one of the things is, how long can this continue? And when it stops, what will be the impact? Perhaps APRA here in Australia is worrying about that same situation, not for their own balance sheets maybe, but for the balance sheet of the Fed in the United States. Then it dropped dramatically, mainly because of that liquidity, and the stock market turned around. Realistically, you may think of the stock market as kind of a betting system, speculative system, but it is an incredibly good indicator of outlook. And when we are very concerned and uncertain, the stock market goes down. When we are less concerned, and in this case, we became convinced that the world was not coming to an end, the stock market turned around, particularly in April of 2009, and a buoyant stock market lifts boats all over the world to a very significant level, and that turned things around, and that spread on corporate debt came crashing down to about the historic average, which is about 525 basis points, and today it's about 450. And it was just until the last couple of months. I shouldn't say today. I don't know what it is today. With the Cypriot problem, I think the spread has probably come up somewhat. It's probably somewhere between 470 and 500 today as a spread, which is still below the historic average, but not much. Why isn't it much lower? Because defaults are low, recoveries are high, money is easy, interest rates are the lowest we ever remember in most parts of the world, maybe not in Australia, but they are certainly very, very low in the United States and Europe today. And as a result, companies of all credit quality, good or bad, are raising money in the debt markets like never before. Money is cheap and plentiful. And the question is another bubble building because of that? And there are, I think, several metrics we can look at to say, yes, a bubble is building, but it's not nearly at the level that it was in 2007 when things were completely out of control. So let's look at some of these potential risks going forward and concentrate on the second one. The chance of a global economic slowdown, and particularly when I talk about the high-yield bond market, I'm talking about the United States economy, but also Europe, China, and of course China is much more relevant for you folks here. And when things are concerning in China, even though things are looking pretty good today in one sense, their growth, their whatever, but of course inflation potential is a risk there and a worry. But if there is a recession, whether it be in the United States or in Asia, this will trigger a large number of corporate defaults. The sovereign debt crisis I'll come back to. The Fed's balance sheet is definitely an issue that I don't have time to go into today. I'm not a Fed watcher or an expert for that matter, but if you take a look at our balance sheet today, the Fed has over $3 trillion of debt on their own balance sheet, and that's up from less than $1 trillion back in 2008. And that is a concern potentially for when this comes to an end and the impact that it will have and what will cause it to come to an end. Leverage buyout and covenant light risk. Just like we have Coke light, there's such a thing as credit light. And credit light means you can borrow at incredibly good terms. Covenant light means there are almost no covenants that gives the lender a control somewhat over the lending. So now we have what's called covenant light loans. These are where you don't have any covenants, or you don't have to pay back in cash. You can pay in kind, like more debt or zero coupon bonds or things like that. More than half of the low quality debt in the United States now is what's called covenant light. And that's up dramatically from a year or two ago. Leverage buyout risk. This, of course, is a big risk because of how prominent the private equity industry is in the United States. The role of collateral in the global financial system. I don't know, Charles or anyone else here, if you are concerned with it, but under the new Basel requirements and under the new Dodd-Frank rules, which is our regulatory act that came as a result of the great financial crisis, more and more transactions need to have very high quality collateral behind it, especially if we're talking about over-the-counter derivatives. And so this is a great research topic, by the way, for PhD students and faculty here or anywhere else in the world, the impact of collateral on the financial system. I think this is going to be one of the key research and regulatory issues coming up in the next couple of years. The bottom line is we need more and more collateral to do financial transactions, and the amount of high quality collateral is shrinking. So you have a supply and demand factor that is potentially going to cause some great disequilibrium situations. Contagion between markets. Did you know that the correlation between risky debt prices and equity prices today is close to 0.8? Means when the stock market goes up, or let me put it differently, when we get a tremor from Europe, which causes the bond market spreads to go up, it also means that stock prices generally go down. Although I must admit I was surprised, I don't know if you were, actually you shouldn't be surprised because it didn't work here. When you got news of the Cyprus problem, countries like in Europe and I think in Australia, stock market has gone down several days in a row. But that's not the case in the United States. We did not seem to take the crisis, maybe because we've seen it so often. And I think, of course, you had your own external or internal events that may have caused the stock market in the last few days to be a little on the negative side. But at any rate, the contagion between markets is great, as well as between countries. Political paralysis, that's a US problem, maybe it's a problem here. Municipal bond problem. When we have a city like Detroit on the verge of bankruptcy, which they are at this very moment, you begin to worry about municipal finance, and that is a worry in the United States today. But let me go back, and I know I don't have a tremendous amount of time, to the main topic, and that's the sovereign debt crisis, a novel approach. And I can explain it very simply to you. We decided to look at Europe in particular, but in general, and we have some data on the United States and Australia, we decided to look at the health of the private sector, and here I'm talking about the non-financial private sector, then I'll get to the banks, as an indicator of the health of the sovereign. And here's the basic idea. It's really so simple that it's almost trivial to have to emphasize it, but I think it's important to at least present some theoretical background. When you have a healthy private sector, then the companies that are part of that sector are usually able to hire more workers and pay more taxes as their profits are higher and their stock price is better, their cost of capital is lower, they can pay more taxes, they can hire more workers, and add to the GDP and the growth of the country. When they are sick and vulnerable themselves to financial distress, they do not have those abilities. That's the simple background. The question is, how highly correlated is the health of the private sector with the health of the public sector? We know for sure that in the case of banks, Ireland, Cyprus now, and to some extent and Spain, that banking problems oftentimes are very, very highly correlated with sovereign problems. But what about the non-financial sector? In addition, we have now some market mechanisms out there which we can look at to determine the implied probability of default of a sovereign from capital markets. And the one I'm particularly referring to, some of you have heard of this market, some of you perhaps not, is called the credit default swap market. It's an over-the-counter derivative on the probability of default of a country. And you can do this, of course, on all sorts of entities. It started in the corporate sector in the early 1990s. It grew. This is the corporate and to some extent sovereign, but mainly corporate CDS market, which is like an insurance market. You can take out insurance on a default just like you can take out insurance on your home or your automobile. And that insurance says somebody will pay, called a counterparty, the par value of the debt plus accrued interest if there is a default. And in order to get that insurance, you pay a premium. And in the CDS market, it's a quarterly premium, although when the risk of default is relatively high, you also have to pay an upfront premium because you may not be around 90 days later to pay your premium. So the markets require an upfront premium. And that's called a credit default swap. That premium can be converted into a probability of default through an algorithm, and I know it's impossible to see, but the algorithm is on the bottom right-hand corner of this graph, and when you get the PowerPoint presentation, which Linda is also going to be on the website, right, as of tomorrow, whenever Linda has time, but certainly within a very short period of time, you'll see the algorithm for converting the CDS premium into a probability of default. Now, the most liquid contract in the CDS market is a 5-year contract. So what we can look at, and that's what this graph shows, for the so-called pig countries, Portugal, Ireland, Italy, Greece, and Spain, the Southern European vulnerable countries, we can look at the probability of default for the next 5 years based on the CDS premium. And if you go back to the left-hand side of the graph, which is January 09 or the end of 08, notice that all the countries in Europe that we are now concerned with had a very low probability of default as indicated by the CDS market. Reason, of course, is the implied bailout from the European community and eventually from this central bank, although at that point the central bank said, we do not, absolutely do not meddle in sovereign debt. We do not have the ability, I shouldn't say that, we do not have a policy of going out and buying either in the primary or secondary markets the sovereign debt of a country. And so, however, everybody was on top of each other. And incidentally, they were also on top of the stronger countries. Essentially, there was no real differential between risk in 2008 as measured by the most liquid credit market out there called CDS swaps, credit default swaps. Notice that differential stayed very low and actually dropped for about a year, maybe even longer than a year, until the end of 2009 and into 2010. Why, when there were some indications of tremors in Europe, did the insurance market for defaults actually drop? And the answer, I believe, is the fact that there was some tremors, and then it became clear that any country in trouble would be bailed out. And so the market breathed a sigh of relief and said, maybe we're even paying too much for this insurance, and it actually dropped. And the stock market came back in many countries as well, because this was in 2009 after the great financial crisis, or global financial crisis, became less of a problem. And then starting in early 2010, notice all the spreads started going up and the probabilities of default started going up and reached a peak probably 2 or 3 times, but I remember one in particular was in the summer of 2011 and then again in the summer of 2012. At that point, some of the countries' probability of default in Europe reached very high levels, including a height, for example, of the 2 countries that I think are the most important, and I've been writing about particularly Italy for many years now, many being 2, since 2011, that Italy, I believe, is the fulcrum country in the sovereign debt crisis in Europe. Italy, I believe, is too big to save, and also is so big in terms of its outstanding government debt that will bring down the euro should it default, or should the interest rates rise to such a level that default is imminent. And so this is why the central bank in Europe now is focused on particularly Spain and Italy, because they are much larger than Portugal, Ireland, Italy, and Greece. But getting back to the trend, so it reached, for example, Spain and Italy reached a height of close to 40% probability of default in 2011 and then again in mid-2012. And then it's come crashing down, thankfully, for those countries, when the ECB made its statement. Again, that statement was, we will do everything it takes to maintain the viability of countries, particularly large countries in Southern Europe, should there be a run on their currency. and should there be a probability of default, which manifests in higher interest rates. So this is the capital market. And the capital markets are extremely volatile. They move up and down based on fundamentals, but more importantly on political statements, on rumors, on bank runs. Our model, for better or for worse, looks only at the financial health of companies. And let's see what our model has said over these periods of time. I'm going to skip over something about Greece. If you're interested, one interesting thing about Greece is Greece has actually defaulted, as you may know, in March 2012. And the reason why they defaulted is not because they were not going to be bailed out anymore. The reason why they defaulted is they invoked, they being the Greek government, something called a collection action clause, CAC. And that says that if there are holdouts in our negotiations to accept a tremendous haircut on the amount of money we owe you, and by the way, the haircut was close to 80% on privately held debt in Greece in 2012. The recovery rate, 21.5%, was the actual. If there are any of these devious, evil hedge funds that don't agree to taking that haircut, by the way, at the same time, we're not asking the central bank or the countries that own the debt to take that same haircut. This is only the private sector. If they don't accept it, we're going to cram it down based on Greek law. That triggered from ISDA, the International Swaps and Derivatives Association, something that shocked the market, an actual default. It shocked it even though the premium was very high, because for many, many, many months they had been saying that there would not be a default. We will not let Greece default. And it turns out they did default and the world went on just normally. But it did create some shockwaves among private investors. Anyway, there's some data here on that. So let me move, and while I'm moving, for your amusement, let's see what the rating agencies were saying about Greece and other countries. A1 back in 2009, then of course they defaulted. These are the Moody's ratings, but they're similar with S&P. Portugal, AA2. AA2 back in 2009, now it's a junk bond, BA3. Ireland, AAA. Spain, AAA. Now Spain is BAA3. Does anybody in this audience believe Spain is an investment grade credit? Their country is in terrible shape, particularly the banks, but it's unemployment of 26%, youthful unemployment 50%. This is the same in Greece. Italy's youthful unemployment is 35%. These countries are in terrible shape, and they cannot compete simply by minuscule changes in the labor situation because their currency is the euro. And the euro is still relatively strong. Maybe not to the Aussie dollar, but it's strong across the board. The US dollar is about 130, or at least it was. I'm not even sure what it is today. At any rate, BAA3 for Spain today. Italy, BAA2 was AA2, and so on. Now, let's talk about our approach. In 2009, I was asked by a fairly well-known risk management company called Risk Metrics, which is a spin-off of JP Morgan, to build for them a new model on credit risk. And we again focused on what we thought we knew better than anything else, and that was the corporate sector. And we built it for the United States, and then we built it for other parts of the world. And that model is known as Z-metrics. Somebody euphemistically called a grandson of Z. It's just a more powerful, up-to-date credit risk model that uses a technique known as logistic regression, and the logistic regression ends up with a direct estimate of the probability of default. Most of my research, when I started back in 1966, 67, used a technique called as discriminant analysis, which is like regression. But from discriminant analysis, you don't get a probability of default. You get a discriminant score, which then you can look at the history of defaults and say something about the likelihood of being in a distress zone or a healthy zone, but it doesn't give you, unfortunately, a PD. And a PD is what's required under Basel II now, and Basel III to come, for every counterparty of banks, and it's used all the time in other risk management techniques. Logistic regression gives you directly a PD, although you may quarrel with the distribution, a logistic distribution, as capturing the true population of corporate defaults. This, we hope, would be an accurate, logical, and robust credit risk model using PDs for large publicly held and privately held companies. So we have models for both in the United States and outside the United States, and based on over 1,000 defaults, credit event sample, very large, etc. I'm going to skip over this. You can go to my website and capture that result, the Z-metrics model. There's the PD estimate, there are accuracy levels that are in the paper and the PowerPoint, but let me get to the results. Let me show you, and we've done this for the median and the 75th percentile companies, based on year-end 2008 on the right-hand side, all the way to the last time we've done it is 6/30/2012. These numbers show the median, the 50th percentile company probability of default, 5-year, for listed companies, and there's the number of companies in Europe, and down at the bottom, Australia and the United States. And so, for example, if you look at 2008, of course, that was the global financial crisis, everybody was in trouble, but some countries were looking pretty good. Countries like Sweden, the UK, Ireland, the Netherlands had the lowest probability of default then, and probably one of the lowest today. Time series from 2008 to 2012. So let's take a look at 2012 now. This is the health of the 50th percentile, meaning that that number on this graph shows that 50% of the companies have a probability of default at least this level. So for Greece, it's 28% probability of default for the 50th percentile. And if you move to the 75th percentile, as of 6/30/2012, the 75th percentile, meaning there's 25% of the companies have a worse financial profile of at least a 47% probability of default. I know there's a lot of numbers that may give you some pause, but let's look at the hierarchy. Greece, Portugal, Italy, and Spain are far and away the most vulnerable private sectors. And they were back in 2008, 2009, consistently over the last 5 years. Meaning that these companies are not doing well and are highly vulnerable. Whether or not their bankruptcy system will mean a default is another question. The other question is their ability to pay taxes, their ability to hire workers, etc. Australia, by the way, is looking quite good. And this may come as a surprise to you, or not, but the Australian, for example, the 75th percentile is only 9.7% as of June 30th, 2012, meaning that 25% of your companies have a probability of default greater than, say, 10% for 5 years. These are the listed companies, the most healthy, usually, companies, and don't necessarily represent the entire country, but I only have data on the listed companies. The United States, slightly worse at 11.2, and you can see the countries that are doing best now are Sweden, believe it or not, the UK is pretty high, Netherlands, and a surprise, Ireland. This is the non-financial sector. And I'm going to show you what happened with Ireland. If you wanted to know how you could make a lot of money in the last couple of years, bet on Ireland. After they went through the crisis, if you looked at the health of their private sector, it was far, far better than their banks. And indeed, we'll take a look at what happened to the CDS spread right now. Let me just end by showing you some data. By the way, we're working on a banking model with Herbert Reichen in the Netherlands, and I are working on a banking model first for Western European countries and then for the United States and other countries to combine with the non-financial model. But I want to just end by showing you these graphs. Now, I'm not sure where you are in terms of our thinking in this, but let me try to make it understandable as well as I can. This shows, the blue dotted line shows the 75th percentile private sector companies' probability of default. The red line shows the CDS probability of default, also at the 75th the CDS probability of default. The blue line is the 75th percentile, the 25% worst companies in these countries. If you go back, the left-hand side of the graph, to 2008, notice how much worse our metric looks than the CDS. And then the inflection point is early 2010. At that point, the market became really concerned about Greece. And it continued. The reason why I don't have any recent data on Greece, all of this assumes a 40% recovery. And once they had their default, the numbers are meaningless. We can plug in 20% recoveries to get a probability of default, and they would still be well over 90%. Today as well, in my opinion, Greece will default again, probably within the next 12 months. But that's just an estimate coming from an academic who doesn't trade in this market. But let me show you some other countries. Portugal. Again, the same inflection point. Ireland. Now look at Ireland. Our metric actually has been reduced over time. We think Ireland's private sector is getting healthier. And notice what was happening in the CDS market, just the opposite, going up, but now they're converging. And if you looked at, actually at Portugal convergence, Ireland convergence, Spain convergence, we're all converting on, for example, Spain at the 25% level. Italy, same story. Until 2010, we were more of an early warning system than the market. Now, and then it changed, and now they're becoming quite similar. Even Germany, finally France. Okay, here's my postscript. Just because you're Southern European doesn't mean you're the only ones who are not healthy. And I think France has a big problem. I think the industrial sector of France is bloated, inefficient, and is beginning to show unmistakable signs of, I wouldn't say a meltdown, but don't forget, they are AAA by Moody's and AA plus by S&P. Nobody seems to be worried, including the CDS market, about France. France is having lots of problems from the fundamentals, according to them. So finally, here's my final comment. Sorry, Stefan, for going slightly over. We think the future for modeling in the sovereign sector is a combination of macro and micro variables. I think both are necessary, but neither by themselves is sufficient. And really, I think that will be the next wave to building early warning systems for sovereign risk, combining traditional macro data with the new type of idea that we're hopefully going to promulgate. Problems, not enough defaults. And so we're going to have to use some other measure besides defaults to build modern databases in this area. Thank you very much for your patience.